Hey everyone, welcome to Unlimited Capital on the Best Ever CRE Network. I'm Richard McGurr, and I'm here with my partner, Chris Lopez. Today, we have a great interview with Justin Freishtat, who's an expert in capital raising and specifically through personal brand building. The thing that I really liked about Justin's approach to personal brand building is that you can tell he's an expert because when most people think of personal branding, they're just like, I have to create a bunch of content, be my authentic self, post a lot. No. His approach from day one was about distribution. Distribution is the most important thing in marketing because if nobody sees what you're doing and they don't know about your stuff, you're not going to make any sales. And so he did this through influencer partnerships, hacking other people's networks. I mean, this guy is just a growth and marketing master when it comes to social media. So I got a lot out of this interview and I hope you all enjoy it.
So Justin, we love to dive into tactical tips here on the podcast. And one thing that jumped out to me is a quote you shared, and that's liquidity is more important than returns. The money is made when you buy. Can you unpack that for our audience?
Yeah, I love that because especially in the beginning, if you're looking at deals, you're probably looking at preferred return. You're looking at all these targets and there's nothing wrong with that. All those things are very important, but you really need to look at the entire landscape and make a determination of, am I really investing from a competitive advantage? Am I getting this deal at enough of a discount that when things go wrong, that inevitably do go wrong, we have enough cushion to still hit these targets? And I found myself in a place investing into a lot of deals that did pencil very well without the anomaly of interest rates going crazy and insurance costs going up, all these things that we saw over the past few years that turned my, cash flow targets down to zero. And all of a sudden I have no liquidity. I have no cash flow and, things can tighten up on you extremely quickly. So there's a bunch of ways to manage these things, but I think keeping more cash than you think you need is always a good idea. And, just making sure that targets are able to be hit even with contingencies of things going wrong.
Can you kind of give us an example of maybe, the way you would either structure deals or underwrite deals, a couple of years ago, then fast forward to now where you're wiser and, learn more, taking a black hour to and how you're structuring things. And are you structuring the returns differently to your LPs now or looking for different types of deals?
Yeah, a couple of years ago, we're looking at how can we force the appreciation in these value add deals, right? We're looking forward on the returns we can create rather than locking them in on the buy. And I learned this a lot from my partner, Scott Boroff. He's done a billion on Wall Street as an investment banker before going private. And he's got access to all these relationships at these banks where we can get incredible deals. And now I'm starting to see what great deals actually look like. And to give you an example, we have a CBRE appraisal on the Bend in Chattanooga. It's 120 acres, came in at 131 million as is, and we bought it at a $26 million valuation. So that's an 80% discount, meaning we could flip it for a 100% return and still give somebody else a great deal on the project. Now, obviously, we're not going to do that. We're going to develop the whole thing. It's a multi-billion-dollar project, but that's kind of what my eyes were opened up to is, when you're new to the space, private placement's hard to get into and you're finding a few operators, you're starting to look at the deals that are available and you really got to dig deeper to other layers to really get quality deals.
So in a deal like that, how soon do distributions start for your LPs? Are you trying to pull distributions to like a Q1 or is that not as important to your LPs right now?
This is why we designed the fund to have multiple vehicles. So we have a customizable fund, which is a little different than, if you're doing SPVs that go into one thing, closed end, fixed offerings. We have a continuous offering and a debt fund where we have the flexibility to always be bringing in capital and deploying it strategically. So those people can get monthly cash flow regardless of how we're using the capital. It's a blind pool debt fund. And then on the equity side, if you wanted to go straight into the Bend, we had that option too, but you're not going to see any distributions cash flow or anything for at least 2 years while we develop horizontally. Now, this project does have a few cash flowing buildings already in place. So we would have the option to, let's say, sell off one of those or sell off some land, return some capital if we want to. But on the way in, we set the expectation of, hey, for at least 2 years, you won't be getting any distributions if you're going in on the equity side. But on the debt side, you can start getting payments 60 days in.
So over the past, 3 years that you've been in capital raising, and that's, similar to how long I've been in capital raising, have you seen investor preference shift in terms of what types of deals people are wanting to invest in versus 3 years ago?
I think it's pretty much the same. It's an investor by investor basis. And that's why I don't come from the approach of like, here's my deal. Do you want to invest in it? It's how do people want to invest, and then making the vehicles and the options for them kind of fit those two avatars. Most of the time, people either they don't need the money, they'll wait as long as possible. They want the biggest equity multiple they can get, or they want income, they want stability, they want predictability. Yeah. And I usually start conversations in capital raising around those two concepts to figure out what does the investor need before even talking about the deal itself.
So let's pull on that thread some more. Talk more about how you actually, I guess, do a discovery call or kind of do the initial qualification on, hey, Mr. and Mrs. Investor, tell me about what you're looking for. Tell me about what you need. Like, how do you find out what the person wants and then guide them towards appropriate things, appropriate investments for them to consider?
I think it's a great question, because in the beginning, when you're raising capital, you just want to take money from anybody. You're just hoping you can raise some money. And then what you start to realize is you need to interview this new limited partner the same way that they're going to vet you as a general partner. I think sometimes we forget that we are partners in this. This is private placement. So I start with questions like, tell me about what your investing journeys looked like. Have you ever done a private placement investment? Like, I need to know, what your acumen and experience is, so that way we can tailor the conversation around where that person's playing in the game. Sometimes it's someone who's brand new that you need to educate them a little bit on how it works, and getting their mindset around, the possibility of risk, and making sure they really understand what they're doing. Just because the SEC says you're accredited by income, a lot of times means nothing to your acumen in investing. So that's where I kind of start. And if someone's newer in the game, I just want to educate them and give them some accelerated, I guess, failure on things that I've been through, the lessons I've learned, small things. I'm giving them the data of things they don't even know how to ask for. Like, do you have third-party reporting? How does that protect a limited partner from things that can go wrong in a private placement? So I start with those things. And if it's somebody who's been in the game and they know their way around, it's going right to the data that they need, because usually those people are a little short fused. They don't want you to waste their time. So figuring out who you're dealing with is the most important thing to do up front.
Would you say that it's easier or harder to raise from someone who's very experienced versus very new?
Very easy to raise from experienced people, and very difficult on the new people, because perceived risk is fear, and it's really just ignorance out of not knowing. So the less you understand, the more fearful you'll be. There are people who passed up the Bend, which is one of the greatest deals I've ever seen, just because they couldn't understand it. And the inverse of that is, the more investor acumen someone has, the better your deal needs to be for them to invest in it. So there's kind of two sides to the coin there. And that's how you'll really know if you have a good deal, is when the experienced money makes a very quick decision and wants to be in the deal.
Yeah, I'd agree. I'd also say that when you're dealing with someone who's very experienced, by the time you get into like the second or third level due diligence questions, they almost always close. Versus like with a new person, like that can just be like tire kicking and it goes on forever.
Yeah, absolutely. I mean, I'll give you a pretty cool, I guess, version of this that is new. I raised capital for the first time into a publicly traded company, Safe Space, that I'm on the board now. And we were raising private shares at 10 cents. The same month, the stock went up to 40 cents. So when you're going out to somebody and saying, hey, you can have a 400% discount on the share price right now, it's very easy to get the capital. And we raised 10 million in 3 weeks. Whereas some other deals that I thought were great deals might take me 6 months to get any money coming in. So the marketplace is going to give you the feedback on actually how good your offer is.
Yeah, I think that you hit on something that's really important, is that, and this has kind of been a theme that you've been explaining the whole time, which is that you have to find deals that there is demand for, and that is a major part of your deal selection process. And that, like you said, that could come down to your investor base. If you have an investor base that like heavily prefers cash flow, or vice versa, you have an investor base that really wants equity multiples, then like that should be a major factor in whether or not you decide to raise for a deal. Is how confident and this is outside of, let's assume that of course it's a good deal, but that you say, do my investors have appetite for this type of asset class, or this type of return profile?
Yeah. Or where do I go to start bringing in the people that are interested in this type of offering?
Well, let's kind of take the conversation on that route, because I know, you and your partners have a great brand. You have lots of great opportunities, deal flow and investor flow coming your way. So how do you go out there and start attracting the type of investors you want and the right type of investors that might be a fit for your deal?
So I think you kind of start fundamentally on how we want to build this thing out. Do you have a bunch of money to go spend on ads and generate a ton of leads? And do you want to, have a system of appointment setters and closers? And like, do you want all this infrastructure? Or do you want to say, I want to invest a minimal amount of money and put in a ton of sweat equity into my personal brand? And that's the route that I went. So I started building my personal brand when we had an organic food delivery company. Like all of my content was about supply chains, farming, breeds of cattle, right? Like nothing to do with the world I'm in now. But I think what people really miss about building a personal brand is it will follow you in your journey. It will re-monetize into whatever you end up doing. So you make that investment one time into people that follow you and trust you. And, if you're surviving off ads, like that bill comes every day, like new leads every day. So it's a longer game, but there's leverage too. So what I did when I first started raising capital, most people with DM outreach strategies would say, okay, who is high net worth people that would invest in my stuff? Doctors, lawyers, let's send them DMs, dentists, right? We didn't do that because that's a very targeted approach on a very niche thing, on a cold message with something that takes extremely high trust. So what I did was send direct messages to every podcast that was in any type of where wealthy people were listening. I didn't care if it was infinite banking, life insurance, or crypto, or stock trading, or real estate, whatever. I wanted to be in long format where the right people could get to know me and then find me that way, or the shorts that got collaborated across all these brands that I was doing this media with. Some of these people have spent millions of dollars building their brands, and then I get the opportunity to go leverage that. And that's exactly what happened. I did, 30, 40, 50 podcasts. And then it was, okay, what other in-person events do you have? Can I speak on your stage? So it's about building those relationships, collaborating them into more opportunities. Next thing I know, I've got so many inbound leads coming through my Instagram and my Calendly. My first year raising capital, I raised 10 million off retail, right offline, no ads, and it only took about 11 months.
I think you hit on something that's really important. Long form is really great at building trust and building a brand. The problem with long form is that oftentimes it doesn't produce good top of funnel, but the way that you accomplished that was getting on other people's distribution. And we're huge fans of other people's distribution because that is by far the best risk adjusted way, to get distribution, because the alternative, like you said, is paying for it, versus if you are the only thing you're spending is time to try and get on somebody else's podcast and getting on their network. And then the other benefit you get is like the brand transfer of credibility of this person and the goodwill he's built with his audience transfers to you.
Yeah. And I've done it both ways, had direct sales companies. And then I went and consulted and managed and built sales teams, from building out the whole CRM to managing all the setters, the lead flow, the ad spend, the ROAS. It's like, you kind of have to take a step back and say, like, what is my identity? Not that I can't do those things. I really hated managing all that. It wasn't fun day to day. I like doing this stuff. I like talking to people. I like, if I don't have to manage any of that and all I have to do is go talk to people, that's a better fit for me personally. And that's why I've leaned into it.
So if you were brand new to capital, then what did you tell these podcast hosts you wanted to speak about? Like, why would they have you on the show if you were new to capital raising?
So the number one thing about building a personal brand is when people want to bring you on their show or don't want to bring you on their show, actually, even just getting that first DM answered has a lot to do with the quality of your brand. The vanity metrics matter. I'll fight everyone all day about this. Like, it matters. The blue check matters. The good bio, the good content. Like, that's your business card. And it's little things. Like if I'm going to send you a DM, I'm going to follow you first. If someone sends me a DM and they're not following me, it gets deleted, right? So there's all these little things that we've figured out in our marketing business that translate into this working for capital raising too.
So when you're looking at like, let's kind of get an operational standpoint here, because you talk about having a sales heavy, ads, a sales team, and that is, people and processes. And then you look at like the operations, the money and time and people it takes to do like more of the branding and podcast outreach. Can you paint us a picture, just a very simple, like side by side matrix for like, hey, what's the sales side look like? And what's the branding side look like? Because they both have their pros and cons. Just paint us in like your experience, what you did on one side compared to the other.
Yeah. And I think the best answer is you do all of it, right? It's probably not one or the other. I don't know why I'm dividing it in. It's probably just because of what I'm doing right now. But yeah, so in terms of, I always went with a group recruiting model. So we would run ads, drive a ton of people, let's say 50 to 100 people twice a week through Indeed ads onto a group interview where basically I would get on there, sell the company, sell the dream, and then tell everybody why they should definitely not do it. You get rid of most people, you tell them it's 100% commission. It's going to be the hardest thing you ever did, but you can make $1 million a year, right? So it's like you get rid of all these people, and then it's hey, if you're still interested in the opportunity, there's a link in the chat on Zoom. All you do is upload a 60-second video of why we should continue the conversation, right? Because if you're going to go the sales model, you got to churn bodies. Like to make it effective, you got to have a ton of people coming in, put them through a training process, put them out there. It's just what I've seen that works. So that would be the model. And then I would do the same thing, group recruiting for appointment setters, and then have them in a go high level and just managing to the expectations and the data. That's the only way I've ever been able to manage people is they get held accountable by data and KPIs. So you put all those things in place and you manage the system. That's and that just comes with a lot of fires that you're constantly putting out, a lot of conversations that are difficult to have. Versus the other model is, I'm all in on this personal brand. I'm accountable to myself. I'm the whole system essentially with some support, VAs, managers that work the back of the DMs, things like that. It's a lot less to manage, but it doesn't scale the way you can scale by building the systems and the teams.
What was the head count between those two, just, sales forward versus brand forward?
In terms of people?
Yeah.
I mean, on the sale, like the funnel side, it's as big as you can scale it. There's no limit to it. I think the most I've ever had on a sales team is around 12 people, something like that. And then the correct amount of appointment setters to fill that funnel. What's never worked for me is when I try to have salespeople that 100% self-generate everything for themselves like that. There are unicorns that can do it. But that will not scale. So I think finding people that are great at one skill set, having them do that one thing all day long is what really works. And then building each piece of that A to Z funnel. And then on the brand side, it's just me, one manager in the back of my DMs, and then all the fulfillment's done by Currents Marketing, which I'm a partner there too. And we've built about 5,000 Instagram accounts. And we monetize through DM outreach. Like that is the holy grail. You build a brand and put out content, not because you want to get billions of views and reach people. I just don't think that works effectively for niche things like entrepreneurs. It's like I'm looking for accredited investors. It's like a tiny portion of the algorithm. So if I go get 1 billion views, like I will probably not get an investor. But if I build great content, pay some influencers to share it and get a ton of great vanity metrics, and then I go target it in the DMs and I'm pulling in the exact right person into that, the trust and credibility is there. The monetization happens when you go targeted.
And I want to just give a shout out and a tip to our best ever listeners here, because, what I'm hearing here is a version of you saying the riches are the niches, right? Common saying out there in marketing. And what you're doing there is just exemplifying the riches or the niches, where if you go out there and try to capture everyone, you don't capture the right person. But if you go out there and get a lot of eyeballs, you build the credibility, and then you're laser focused on, hey, here's the message. Here's the avatar of our potential investors we want. You can go out there and find them and build a very effective funnel. And I want to loop back around too. And, I'm not saying sales is better or branding is better, and I don't recommend people try to do both at the same time. If you try to do both at the same time, it's probably going to be a recipe for disaster. But, I've been in marketing and lead gen for over 20 years now. And one of the very impactful experiences I had, this was in 2009, 2010 timeframe where Google AdWords was still the heyday. And you could absolutely crush it on Google AdWords for a non-real estate business that I was in at the time. Things were great until things weren't great anymore. And by that, I mean, back then it's called the Google slap. Google just shut off. All of a sudden, they changed their terms of services. And we got caught up in there, even though we were legit, we're doing everything right. We got caught up in, legal minutia. And then for 6 months, we had zero lead flow coming in, which we were spending out $40,000 a month on ads, had a big team of people that were working. We got upside down pretty quick. And then we spent, I think, like $30,000 a consultant to come in and unscrew it up, to use a polite four-letter word on there. And that really made me realize I want to shift more towards a personal brand. And also I want to shift towards multiple streams of leads out there, because eventually one thing gets shut off. But I lean more towards a personal brand like you do, Justin. My personal brand is here until, I leave this earth. And I control a lot more of it as well. So I love the fact that you've been through both and you're really leaning into the personal brand side of things.
Yeah. And you're kind of taking me back when you said all that, back to that era when we were at Heartland Foods and we were doing direct mail campaigns. We had a call center and people were answering their home phones, like all these things that you did that eventually didn't work anymore. Like it's always evolving. I remember Facebook ads. When they first came out, they were dirt cheap. We doubled the size of our company off Facebook ads in 2015 to 2018 until all of a sudden it didn't pencil anymore and it got too expensive and we stopped doing it. And that's what kind of built where the personal brand side was born is I was looking at new ways to generate leads. And, we were an organic, healthy food delivery company. So I went out in the community and started talking to CrossFit gym owners, dietitians, trainers, chiropractors, and started setting up these educational seminars and cooking free samples on Saturdays when, the Murph was done or whatever the CrossFit workout was. And we were getting better results, higher quality leads, equal amount of sales without that mass grind and big ad spend. And it was more, a boots on the ground effort. And that's where kind of the light bulb went off for me. It was like, if I can just compound this online, the sky's going to be the limit.
So one thing that I see a lot of new entrepreneurs, new capital raisers, new syndicators come into is if they're out there trying to raise their first dollar or get beyond their first $1 million out there, right? I see a lot of people get stuck in this trap where they focus so much on their personal brand that they do zero sales to their network. And then that's a very hard flywheel to start. Like you raising $10 million off of, I think 12 months of podcasting, I would put you in that's a top 1 or 2% type result from what I have seen from people out there doing. But you did it. So that means other people can do it as well. But going back to tactical tips for if someone wants to go out there and build a personal brand today, where would they start? What would be the 2, 3, 4 steps you'd say? This podcast ends, turn off your YouTube app, and then go do XYZ.
Yeah, let's assume that this is somebody starting from scratch, less than 10,000 followers, doesn't have a ton of content, low engagement. You got two routes here. It's I'm going to go create content until I'm blue in the face and hope that within 10 years I'll grow a brand, which I want to discourage almost everybody from, unless you really are going to go compete with the full-time content creators, because this is a professional sport now. The highest paid people on these platforms make more money than professional athletes. So for you to think, hey, I'm going to run a business over here, I'm going to create some content and go, build a big brand, it's foolish, right? So I would say the first thing you need to do is just say, I know I need to put some money behind this brand and invest in some influencer campaigns, shout outs, things where my content will get distributed, whether it's good or not. Because if you leave it up to Meta to do it for you, you're going to lose, especially if you're in niche content. We're not making funny cat videos here that everyone loves, right? So I think just being humble about that in the sense of the reality of the odds of me organically blowing up to the point where anyone cares about my brand is so small. Let's take the shortcut And I'll give you an example. Like we do these celebrity growth campaigns. We did one with Floyd Mayweather a month ago where he puts up a bunch of signed memorabilia and says, hey, one of my followers is going to win all this. All you have to do to be entered to win is follow this list of accounts. Like, so those are paid spots at Kern's Marketing. And all of those people got about 35,000 real followers from Floyd Mayweather's brand in about a 2-week period because of that giveaway campaign. So that will launch your brand overnight. And then, of course, everyone says, well, that's cheating. That's not organic. It's like, well, then instead of spending the $5,000 on that, spend $100,000 on the boost button with Meta and you'll get 1/10 of the result. So like everybody who's winning on the platform is spending money on the brand. And you have to do an equation of, okay, if I go the traditional media route and ads and all this stuff, how much am I going to spend versus if it costs $5-10 to build this brand that then becomes a monetization engine.
Yeah. So you're still using paid media here. You're just being a lot more surgical. And that I also think that you're playing into like the nature of the platform better, which is leveraging people's networks, leveraging trust.
Yeah. And if you don't, spend that money to get your following to 10, 20, 30,000, nobody of value is going to answer your DM. So a lot of people will just create content. They'll try to do the DM outreach strategies and they're getting no results because like it or not, the vanity metrics really matter on the first impression.
So we have talked about how this is very niche, especially in capital raising. You're talking about accredited investors. So you're talking about someone like a Mayweather would probably not be a good idea if you were trying to raise capital. So then how do you select you could call it influencer partners for capital raising?
So I don't, right? I would rather have, and this is exactly like the thought process. I don't care who's following me. I'm not trying to raise money from them. I'm trying to get a ton of people to follow me so that when I send a direct message or somebody meets me in person and then starts following me on social media, they go, wow, he's the guy, right? It's like if somebody meets me in a long form content like this, whether it's a virtual stage, a physical stage is better. There's a total different dynamic of respect and credibility that raises the money. So it's all about the perception of when someone meets you in person. It's like being in shape. Like I would never give money to somebody who doesn't take care of their body. It's like your social media is part of that business card. Like you need to dress well. You need to take care of yourself. Like every area of your life is going to raise capital, or it's going to prevent you from raising capital. So I just see the Instagram as the extension of whatever I do in person. Like it goes both ways. I take people from online to in person and from in person to online. It goes both directions. And it's not about going to 1 million followers. It's about, okay, who am I really in the real world? Like who is that guy? Let's make that brand congruent online. Because there's a lot of people killing it in the real world that are losing business and they're not raising money because their online presence sucks.
Do you focus on like one social media channel like Instagram, or are you on a couple channels? Like what ponds do you fish in, so to speak?
So for me, it's been 100% Instagram. I've leaned into that heavy. With Heartland Foods, it was all Facebook, but that was a little different. It was more of a community thing. It was families. We had a Facebook group. It was recipes and stuff like that. So I thought Instagram would be a better platform just because not that all the other platforms aren't great. It's just that I don't want to focus on YouTube as much because I'm not trying to monetize off of views. I'm not, so I'm looking at like what platform is going to do what for me. And Instagram is the business card. I mean, if you do all the others, great. I think that's wonderful. But some people want to be all in on TikTok. Or LinkedIn is one that I'm starting to pay attention to as the number 2. And, that's because that's probably a more professional, better place to raise capital. But still, like if you're speaking on stages or you're doing media like this, people are going to end up on your Instagram.
Yeah, I think it's fascinating that you're doing Instagram because for a lot of, capital raising and real estate syndicators, LinkedIn is usually like a holy grail. That's where more professional, higher net worth. And I love the fact that you're doing Instagram. And it goes to show that you can make this successful on any platform out there that has distribution. Instagram, YouTube, LinkedIn, TikTok, whatever it is, they all have massive distribution. But you got laser focused. You owned one channel. You're crushing it. And then, hey, you start crushing it. Then you start going out there and doing the next channel. So if you wrap this up here, I want to make sure our listeners are really taking away some of these key points here. because while Justin is doing a lot of, different things, you can also see he has intense focus out there, intense focus on his process for going out there and building his brand, intense focus for going out there and hacking other people's audiences through podcast appearances or, influencer partnerships and things like that. Intense focus. Hey, I'm going to focus on one platform. I'm going to focus on that. So Justin, this has been a phenomenal podcast. As always, I always strive for me to take away like one nugget for myself. And I have definitely taken away a nugget or two. And wow, I got up to my social media game. So I appreciate this. But for our listeners out there who want to follow you, to know more about what you're doing from a marketing standpoint or your deal flow, where can people get in touch with you?
Instagram's probably the best place, but I'm on every social media. So, and there's only one of me in the world with a crazy last name like this. So it's just at Justin Freishtat on all the socials. That's Freishtat.
So coming from a Chris Lopez out there who has the most common names in the world, I have to say I'm a little bit jealous because I've never gotten a unique Chris Lopez on anything in my entire life.
That makes sense.
Justin, again, thank you so much. I appreciate it. I know Richard's appreciated this, and our listeners here at the Best Ever Community appreciate the knowledge as well. So thank you so much, and enjoy the rest of 2025, man.
Appreciate it. Thanks for having me.